Hi, I'm Tom Stevenson, and welcome to Construction Business Management. Today, we're going to be looking at a financial statements case for a home building company, and we're going to try to look at it and interpret the information. So, if you haven't been following this series of videos, just look in the description below. I've got a listing of the different videos. You might want to go back and start from the beginning, but if not, and you just want to get a better understanding of the financial statements, we'll go through this case between the income statement and the balance sheet to try to look at it and sort of decipher it based on some of the things that we've been discussing thus far in the course. So really about how to review an income statement and balance sheet. So I've got a very simplified income statement here that is for ABC Home Builders. We're saying that ABC, they build about $5 million $5 million worth of sales in a year. In year two, they do, or they're projecting to do 10 million. They've got job costs of 4 million, and in year two, they've got job costs of 8,500,000. They've also got overhead of 800,000 in year one, and it's doubled in year two. They've got profit in year one. They've got a loss in year two, $100,000 loss in year two. They had to pay 66,000 in tax, so they ended up with a net profit after tax of 134,000, but a loss. Well, the good thing is you don't have to pay any tax, but that's not really good. That's why sometimes it's good to pay tax. It means you made some actual money. So we have their balance sheet. And their balance sheet is, and remember, we talked about balance sheets in an earlier video lecture, and the balance sheet must always balance. So in other words, our assets, our short and long-term assets, 1.2 million or $1,200,000, must add up to our total liabilities and our total equity. So this plus this also must equal 1,200,000 to balance. Okay, so we can see certain things here. We can see accounts receivable, we can see work in progress, we can see inventory, we can see a bunch of different things going on through here on the balance sheet. So let's now take a look at what's actually going on. So I've left this over on the right side so we can sort of take a look at some of the points that the information's giving us some indicators on, right? The first year showed good profit at 200,000 before tax. And the second year, the business expanded quickly. Well, by expanded, I mean, look, your sales are 5 million and now they've doubled. So that's a pretty quick expansion. Maybe that means you built one home, or maybe you built several homes the first year and then you did double the homes the second year. Maybe that's what that means. Our cost to build them went up. That doesn't necessarily mean that's a bad thing. It could have been bigger houses, etc. But if we weren't getting extra money as a result of that, that definitely can be a bad thing. So if we're a home builder, that would be some indicator there. We see the gross income. So of our overall gross income, we've got $1 million, which is the difference between your sales minus your job costs, right? If you recall that from our earlier lectures. And here we've got $1.5 million. If we actually ran some of the formulas that we looked at, like gross margin, we would see our gross margin is a smaller percentage in this particular case of the overall sales, because we've got larger numbers here. So that's telling us something as well. So giving us some information. Now our gross income, if we look at our overhead costs, now this is strange to me, so I would be right away wanting to investigate, how is it our overhead doubled? Like usually your overhead does not go up in proportion to your sales. It goes up, and it usually kind of goes in a stepped kind of fashion, your overhead. So, you have an office and it's a certain size and it holds a certain amount of employees, but maybe it's big enough it could even hold a few extra employees. Just because you doubled your sales, you might not need any extra employees like admin staff or estimators, etc. It's just now you're more better utilizing that staff. So your overhead might not even change when you increase your sales. But at a certain point, it certainly does, because maybe you need a bigger office. Maybe you have to hire another estimator. So then that would increase your overhead. But it's not something that is generally a linear relationship between the sales. It kind of goes up in steps. In fact, that's a big indicator with small businesses, is when your overhead, when to increase your overhead. It's very helpful as a business that's starting out to be lean and mean, so to speak, to not have too much fat in your overhead. Because if there's a down cycle in the economy, it becomes a lot easier to survive as a business if you're limiting the amount of money that goes out every month. In our previous video, we talked about cash flow, and you definitely want to be cognizant of your overhead costs, because those costs are happening month in, month out, whether money's coming in or not. So we have to keep that in mind. And so I am questioning what happened here that this doubled. And so that would be in a real income statement, you'd be able to dive in and compare what went up so much from this year to last year. Oh, right, we hired these 4 people. Oh, right, we also went to a different office where the rent was twice as much. That would be telling you, it doesn't tell you that was a good decision, but that would be at least telling you where the issues are. Because we went from a profit to a loss, so that's got to be of a concern. Sometimes a business, when they do make that step or leap to grow, they do it with the intention of the long-term plan, meaning that maybe in year 3, they expect to have 20 million in sales. And if they expect to have 20 million in sales at that point, without dramatically increasing their overhead at that point, then that's going to make a huge difference to their bottom line. It'll be significantly more than this is if everything else is done well. So you have to be cognizant of the interrelationship between the different elements and how they work together. And then you have to ask a lot of questions. So it's not just, looking at the number and jumping to a conclusion, but it is seeing something and then wanting to ask some questions like, what's going on with that, right? And so I would look further along here. I would say, accounts receivable, accounts payable, overhead costs. Now, in an upcoming video, I'm going to do ratios, and we can do some further analysis with the ratios. And I'll do it in this case in a future video. But account receivables, account payables, overhead costs, work in progress all went up by 100% or more in year 2. So there we can see here we've got accounts receivable, and we've got 300,000. It went up double. That may or may not be surprising, especially depending on the type of business that we're in. Work in progress, 350 to 800,000. These could be things if we are building homes custom for clients, then that might be a question that we'd want to ask. Are we invoicing quick enough? Are we collecting enough? Are we turning our work in progress into accounts receivable quick enough, right? Work in progress means you're doing work, but you haven't invoiced yet for it. So that's just like money that's sitting there that hasn't been invoiced yet. So you might be able to make those amounts smaller, which when we just in a previous video talked about cash flow, that might improve your liquidity to be able to pay your sub-trades on an ongoing basis. So that gives you some information there. More money was invested on land purchases and equipment in year 2. So that might be justifying where some of the extra costs in here are coming in. It says designs, but I think that's supposed to say designs and land purchase amounts. So we've got 200,000 and 450,000 there. I think I had that in the earlier one over here. Yeah, I had it down as land, right? So I think I didn't make that change over for here, but we'll say that's designs and land, let's say. So we've got 200,000 and 450,000 there, because maybe we're going to be shifting from building custom homes for people to perhaps building a home on spec or a couple of homes on speculation ourselves. So that might have been part of the increase in costs for us. So that could help to justify some of the reasons and logic behind the extra loss here. So the needed cash was supplemented by the 200,000 from the owner, an increase in overdraft of 100,000 to 360,000. So overdrafts, that would be like a line of credit that the business has. And we talked about the types of liabilities when we talked about financial statements. So current liabilities are things that are usually due within a year. So unless we planned on turning this property or land over within a year, that may not make sense. You would likely have to have a mortgage on that property or short-term financing, maybe then in that case if it was under short-term financing. Definitely, if you plan to carry the property for a number of years, you would want to have it in your non-current liabilities or long-term liabilities area, right? So you try to match the time period that you are utilizing the asset for, if it's short-term or long-term, with financing that's in alignment with that. It's kind of like how your credit cards work. You don't buy a house on credit cards. You shouldn't buy a car on credit cards. It's a longer-term item. It should be financed over a longer period, and because it's an asset, it's secured on it. So that way you also pay lower interest rates. If you're on a line of credit or short-term financing, the interest rate tends to be much higher. And so that in tight margins, like construction businesses operate on tight profit margins, you definitely want to keep your financing costs as low as possible. So long-term debt is more than the long-term debt and owners. Long-term assets is more than the long-term debt and owners' equity. Like the payments of your assets should be comparable to the liability payments, is what that's trying to say, as I mentioned. The owner likely would have been better to increase their long-term financing now and left room in the overdraft, because you definitely want to have that short-term overdraft line of credit viable. You don't want to have it used up, that you don't have hardly any access, because looking at this, this is not showing next to nothing on cash. So you're really eating up your lines of credit instead of using cash, because you really don't have any cash at this point. So those are some of the points that you want to think about. And you want to also keep on top of your work in progress. As I said, invoice it as soon as possible. So you want to keep these amounts, because let's say that you had moved these into accounts receivable and that you were aggressively trying to get your accounts receivable paid, you could greatly reduce these amounts. And if they're getting paid much more quickly, you would be able to lower these amounts, or you would be able to have some amounts in cash. Really, the truth is, if you had this down by say $350,000, right? That extra $350,000. So you don't say you had accounts receivable 250. That would give you $350,000 extra cash. So you could wipe out this overdraft and still have some cash in the bank and not be paying those monthly fees on it, just by aggressively going after your accounts receivable, moving more work in progress into accounts receivable. You still have amounts in that, because there's always going to be amounts in that. But if you could lessen that, that could make a big difference to your bottom line. You'd be surprised on that. So collect debts quickly. Your creditors will more than likely want payment before you are paid for a job, and you have to work out as long a payment terms as possible. So that would be another thing that this is giving me a very strong indication to work towards. So unless your business has been operating profitably for a sufficient period, the lag between collecting your debts and paying your suppliers will typically always cause some short-term cash problems. And unless you've got a lot of cash that you put into the business yourself, or if the business has been running a number of years and you've retained those earnings, like we talked about in a previous video, in the business, then you've got a large amount of cash, then you might not be so reliant on banks and lines of credit and the costs that that incurs. So those are things to really think about when you're looking at a financial statement, and look at the trends. You know, it's great that you've increased your sales, but it's definitely not great that you've got a loss. So then you want to sort of decipher what exactly is going on. And a big one here is, why on earth did our overhead double during the year when our sales only doubled? Could we have done this? You know, whatever is going on with the overhead, if our overhead only went up to, say, up by 200,000 to $1 million, that would give us now profit of 500,000 instead of a loss of 100,000. It's a big difference, right? It's a big difference. And it's something that, looking at that, that might be a very, very doable thing. So keep a good understanding of how the financial statements work and what the different information means. If you're making decisions about the business and overhead, think about it very, very carefully. It's very much like your own personal situation. You've got a job, you've got a certain wage, that certain amount of money that's coming in. How much money is going out? What are my expenses? Do I really need this 5,000 square foot house, right? That's costing me, $8,000 a month in expenses when I've only got $7,000 a month coming in. Those are things that you got to think like in a business, and they're things that you got to think about personally as well. But on a business, it's on a higher scale. There's a higher level of responsibility involved with it. So in our example case, there was a budget prepared. The owner hoped to increase sales by 100%. They did increase, but the gross profit margin percentage dropped from year 1 to year 2, as we mentioned. Try to set a gross profit margin percentage target for each job and see if you can achieve it, right? And if your projects add up to that over the year, then your company will be achieving the overall goals of being able to pay the overhead and achieve the profit target that you've set. Again, we've discussed this in previous videos. Contain overheads when sales increase on your hard work will be no extra profit. Perfect example. And I've mentioned it already. Overhead should not follow in a linear alignment with sales. So it should not double when sales double. All right. It may not have to move very much at all. But in certain cases, when you reach a certain stage, you're going to have to increase. I got to hire a new person, that's going to increase. And run scenarios, run simulations. What does this look like? That's the nice thing about financial statements. You know, if you're making certain decisions, you can set it up in a spreadsheet and you can do a sensitivity analysis, a what if analysis. At least you have an idea what's going on, so you're not surprised and put into reactive mode. When you run a construction project, you don't like being in reactive mode. Well, you know what? When you run a business, you try to be as proactive as possible, and that way you can deal with the unknowns as they come up. So this is what I wanted to cover in this case study example, and we're going to be diving more deeply into financial statements and cases in the next upcoming videos. I'm Tom Stevenson, wishing you a wonderful day, and remember, work on the business as well as in the business. Have a great day. Bye for now.